far as finances is concerned. And so I just wanted to spend just 1 hour max just to talk about a few things, what I call like the 5 commandments of money. And I'm just going to start sharing the screen now. Now, what I'd like this to, if you have any questions, you can just write the questions. I don't know the questions as we proceed, and then once I'm done, then we can we'll definitely have a Q&A session. All right, so it's great to see you all. Hello, Ellen. Hello, Esther. Hello, Esther. And then I guess we're welcoming the others as they join us throughout the session. So I'm going to start sharing my screen now, and let's start. First of all, I hope you can all hear me clearly. If you can just share an emoji if you can all hear me clearly. Fantastic, thank you. Right. So I'm going to the money commandments now. Now, is this a commandment? Is it just basically, I would say money guidelines, but I say commandments because I've seen so many people breaking this so often. You know, a lot of people break these, I guess I can call them guiding principles. And I usually see a lot of backlash, you know, because of this principle that have been broken. So what are these 5 money commandments and what are they all about? Number 1, it seems very basic, but when I say it, I share it all the time. Thou shalt save. Thou shalt save. It's important to save. Why? Because it's clear to everyone that, you know, things we're in a very interesting period and things have been quite tough for quite a few people. But at the end of the day, no matter how tough things are, you've more than ever realized that we need to have certain funds set aside. We need to have some money set aside. Why? Because with the rate of inflation, the way things are going, devaluation and what have you, it's important to have something. Otherwise, you find that you're constantly living, you know, paycheck to paycheck, you know, project to project, which really isn't sustainable. Now, the question that someone would ask is, how exactly is that meant to work? You know, how do you drive that? How do you make that happen? And I think if we start from the basics, we go to your basic monthly expense management. Number 1 is, do you have a budget? Do you have a budget? Do you understand how much money comes in on a monthly basis, how much money goes out on a monthly basis, and then how much of that do you actually allocate in terms of expenses, in terms of savings, in terms of, you know, your investments? Because I see a lot of people just trying to wing it, you know, that, oh, I'll save, you know, whatever is left, I'll save. But the truth of the matter is that with the way life works, there usually isn't anything left at the end of the day if you're not deliberate about setting money aside. And so there's a general rule of thumb, which basically says that you need to have no more than 70% of your expenses, of your monthly income rather, going to your expenses. Then you should have about 20% for saving, meaning that's the amount you're just going to set aside. And then 10% is the amount you're going to put into what we call investments. Why? Because it's important to put money into a venture that's actually going to bring returns. So what happens when we're saving is that you're just setting money aside, you're keeping money for the future, which is not bad. But when you're investing, you're actually saying that, okay, I'm setting money aside and I expect returns from it. And then with your expenses, it's just saying, you know what, this is just to take your bills and what have you, and I expect no returns except, you know, just to stay afloat. So 70, 20, 10 is a general principle. So you don't spend more than 70% of your income, you know, on monthly expenses, 20% on savings, and 10% on investment. Now, why is this important? In practical, and I like for this session to be very practical, so I'll share some of my personal experiences and experiences of others that other people that I'm involved with or have shared their own experiences with me. I won't name names, you know, but just to share what they've gone through. And I see a lot of people, particularly salary earners who have spent the entire salary even before it comes, because they know that some amount is coming on day X. So let's say your payday is on the 1st of the month. And so you already know that, okay, because payday is 1st of the month, I'm going to spend X, Y, Z. And then in the days of post-dated checks, a lot of post-dated checks were flying around. Now people have, you know, almost paid, you're buying things on credit in advance. And then you'll now find that by the time the salary comes in, let's say it's 100,000 for the sake of illustration. By the time that 100,000 comes in, you know, 90% of it is gone, if not 100%, because you pre-spent the money, thinking, okay, this is how much I have. It's 100,000, therefore I'll spend 100,000. No, you are not supposed to spend more than 70% maximum, 70% of your income on a monthly basis. Why? Because shocks will happen. Something will always happen. That's the way life works. Something will always happen to to sort of shake you a little bit. Some unexpected expense will come in. Now we're talking about petrol being more expensive, tariff hikes, all sorts of things. Things will happen that are not necessarily within your direct control. So if you're thinking, well, I'll control my spending and therefore not spend more than X amount, things will happen. So you must always have that buffer. And so what the 70% does for you is that it gives you a buffer. So once you make sure you spend only 70% of your monthly income, then you have something else, what we call the buffer. Now, what do you do with that buffer? You now take that 20%, again, using the example of 100,000, you take that 20%, and that 20% is now what you put into what we call savings. That's your saving money aside. And you could be saving for a particular thing. And it usually helps if you have a target for your savings. So I'm saving for my wedding. I'm saving for, whatever it is for education. I'm saving for whatever it is you want to set money aside for. It's not going to happen by magic. You have to be very deliberate and intentional about it. And then 10% is what you spend on investment. And I like to say that money is social. Money likes to bring its friends, but money is also a very faithful servant. Money will go wherever you send it. So if you send it on a fool's errand, it won't argue with you, it will go. If you send money on expenses and you decide, I'm going to spend all 100% of my salary or my income and just waste it, it will go. The money is not going to argue with you. But if you now put the money into something that's actually going to bring returns, that's what it's going to do. So money is a very useful tool. It's not good or bad in itself. Intrinsically, there's nothing, it's amoral. The question is, what do you do with it? And you can do very good things with money. People do very bad things with money. But you also have to be planned, you have to be very strategic and intentional about how you plan, particularly as if you have a big event coming up in your life, or you have a life change, you realize that it's now more important than ever to be intentional about how you're spending your money. Now, if for families, the question is, if you're part of a family, do you have a family budget? Because now we're talking about income of an individual, but for families, do you have a family budget? Do you as a family realize how much you're spending on a monthly basis, or is the money just going? And the thing about money expenses, particularly for families and individuals, is that if you're not spending money on one big thing, you may not know how much is going. So for instance, now, if I were to use that example again of 100,000, if I spend 50,000 or something, I know that 50,000 has gone. That's a huge amount. But imagine I'm spending 1,000 today, 1,000 tomorrow. You're spending 1,000 every day for 30 days. That's 30,000. So that's 30,000 out of your 100,000. Right? So it's not necessarily about the very big things. It's about what you're consistently spending money on. And so there's a very, I may have to say, it's very unsexy in terms of, having to eyeball and outline, where is my money actually going? If I'm sending this money on an errand, where is it going? Can you track your expenses? Do you know where your money is going and what it's doing? Are you frivolous with your money? And you may think I'm not being frivolous because I'm not buying that one big thing, but that little 1,000 naira every day, or that 500 naira every other day, by the time it adds up, your 2K here, your 3K there, on little things. I had a session with someone, and this was with an SME, and the business owner was quite shocked when we were eyeballing the expenses, and he realized that in a month, in the period of about 2 months, he spent 40,000 naira on airtime. He didn't realize that because he was just wondering, I'm doing business, money's coming in, and yet I'm not seeing the returns. So it's the little things, the big things are easy to identify. It's the little things you need to pay attention to. And that's why I'm spending some time on this. So thou shalt save, but saving is not going to be automatic. It's not something that's going to be intrinsic, that money is just going to automatically stay in your pocket or stay in your account or stay in your wallet. It's something you have to be very deliberate and intentional about, and put structures in place to make sure you can actually save, okay? Now you have different bank apps who tell you they have target savings, they have this and that. And so what it is you can do to help yourself is, as soon as money comes in, you can set up what we call like a standing alert, a standing instruction to move the money, X amount, however much it is you decided you want to save, and move that money out. And I always recommend move that money out of your account. You cannot save money in an account you're spending from. Please let me repeat this. You can't save money in the same account you're spending from. It's just not going to work. Okay, so you need to take the amount you want to save or invest and put it in a separate account. And it's easier if you're able to automate that process, because it helps you, because we're still people, human beings are human beings. So if you say, I will do it, or just leave this amount, this balance in my account, I won't touch it, no, that money is going to go. So take that money, move it into another account. You set up an automated structure so that, on a monthly basis or whatever period it is you put, that works for you, you can actually set that money aside. So that way you can have consistency. you know, because it's not about being here today, gone tomorrow, up and down. You need to have consistency for it to be tangible. Otherwise, you ask yourself, why am I saving? It doesn't work, you know. And then there's a 10% that's going to investment. Now, as we're going through this conversation, you know, I'm going to go deeper into each of these areas, but I just wanted to set some, you know, guiding principles. And I know many of us may know this already, so I'm just trying to reemphasize the basics, the principles, you know. And if there's nothing else to remember from this session, remember 70, 20, 10. 70%, don't spend more than 70% of your income. Always make sure you set aside 30%. That's your buffer. And that 30% buffer is what you play with. Now, some people may say, I'm going to save 15%, invest 15%, whatever it is, just make sure you have a buffer, because the shakes will come, you know, the rain will pour, as they say, you know, prepare for a rainy day. And, you know, and if there's anything 2020 has taught us, that life can get very interesting very quickly. A lot of changes can happen very, very quickly, you know. And you're having to spend money on things you probably hadn't planned on before, you know. So I mean, at the beginning of the year, you probably thought, okay, here's how much I'm going to be spending in transport and what have you. And now, for those who have to work remotely, you're not having to spend that much more, maybe perhaps on data. You're having to spend that much more in, if you have children, you know, keeping your children occupied and entertained, so they're not, you know, disturbing you too much as you're working from home, or whatever it is. Something will always come. Or, you know, you decide at some point in time, you have a life change, perhaps you have to relocate, or you're going to, your family is increasing, but, you know, anything can happen. Anything can happen. And if you're waiting to the last minute, to that point in time where you're about to make that change and you're expecting the money to come from somewhere, you will struggle. And that's where you now see people, you know, going into making all sorts of funny decisions as far as, you know, borrowing, lending, and what have you. So I'm spending some time here just laying the foundation, because everything else I'm going to say going forward is going to be laid on this foundation, that you must have certain amount that you're setting aside for your expenses. You must have a certain amount you're setting aside for savings, and you must have a certain amount you're setting aside for investments. Why? Why do you need savings? As I said, rains and shocks will come. Why do you need investments? Because you cannot save yourself rich. I'll repeat, you cannot save yourself rich. What do I mean by that? Saving is just putting money aside, right? It's just keeping money aside. But when you invest it, you're giving that money the opportunity to grow. So imagine you're taking money and you're putting it, for the sake of example, just under your pillow. But now when you're putting, it's just set aside. But when you're investing it, you're saying, okay, money, I'm sending you on an errand and I expect you to come back with friends. That's what you're doing. That's basically what investing is. Sending the money somewhere and asking to come back with friends. Bring more of you. That's basically it. Sending money, when you're saving, you're saying, okay, money, just stay somewhere. Don't go anywhere, just stay right here. And then when you're spending money on expenses, you're saying, okay, money, I'm sending you on an errand, just go and, you know, sort this out for me. So that is the principle. Those are three basic principles that we're going to be talking about today. So moving on. Now, why am I saying that? I'm just sharing this screen now to show you just a sample, you know, of what someone can, if you're looking at that 100,000 naira example again. Now, our savings rates, our investment rates, and what have you right now in the market are really, really low. This time last year, this is not what we're talking about, but this is what it is. So the average saving rate is between 1% and 3%. And so year zero, if you can all see the screen clearly, year zero is assuming it's today, it's here, it's now. And I just put it in years, just, you know, just for illustration. This can be in months, it can be year zero, month zero, whatever it is. And so imagine that you now have this 1% savings rate. And what this is showing you is that, okay, if I were to save 100,000 naira over this particular period, right, at 1% per annum, this is per annum now, that's per every year. If I were to save this 100,000 naira every year, then this is how it is going to add. There's something called compound interest. So as I save the 100,000 naira, in year one, the interest I get is 101,000. Now my 1% now comes up on the 101,000, not the 100,000. So it's growing. In year two, my 1% comes on 102,000. Year three, you know, and so on and so forth. So this is how compound interest works. Now this is just 1% savings interest rate. I'm using an example. Yeah, assuming this was an investment rate now. So what you should do before you enter an investment, ask yourself, how much am I going to get back? So when people throw all sorts of rates at you and say, oh, 40% investment, 30% investment, 20% investment returns, you know, do your quick calculation and say, what does this actually mean? So if I were to put 100,000 naira again, using that example, and then I'm investing in something, and then the returns they're telling me is 20%. So which means year two, I expect to get 120,000 naira. And then, year one. Year two, I'm going to get another 20% on that 120,000 naira, not on the 100,000 again. So there's something about multiplier. There's something called the multiplier effect. So the money automatically starts multiplying on its own. Why am I sharing this? I'm sharing this so that you can see the importance of starting early. If you haven't started saving and you haven't started putting money in instruments that can give you returns, you're sort of shortchanging yourself because you're reducing the period of time that that multiplier effect can take place. So if you're saving money and you're having a fairly decent interest rate and you're saving early, and you're saving consistently, then that multiplier effect just continues and continues. So again, I just use the very basic 1% savings interest rate. But if it was, assuming it was 10%, assuming it was 15% or 20% or whatever it may be, and that just gives you a sense of how much you can actually get. And this principle is called compound interest. Okay, it's a multiplier effect of compound interest is the technical term that we use for it. And so when people talk about compound interest, it's basically saying that when you put money in something and you have interest on it, then the next interest that comes in goes on that amount that has already increased. So the money is constantly increasing. So that's what it does for you. So that's this grid here. Okay, the pink side. Now if we're to look at the green part, which is the slightly scary part, now there's something called inflation. What's inflation? Inflation is the rate at which things become more expensive. That's the easiest way I can put that. The rate at which things become more expensive. And for those of us who are in Nigeria, the actual monthly inflation rate right now is over 12%, which is really high. Which is really, really high. So what does that mean? It means that, let's look at that grid now. Again, I put it in years, but it can be in months. Assuming you bought something in January at 100,000 Naira, at a 12% inflation rate, that is going to cost 112,000 Naira in February. Okay? So that's what inflation is. So what does that mean? It means that assuming you hadn't set money aside to save, right? And you're assuming that, I'm just going to keep buying this thing at 100,000 Naira. February comes, March comes, or whatever period it is comes, and you see that that same thing that you thought you were going to spend 100,000 Naira on is now costing you 112,000 Naira. Now you've done nothing wrong. Your income is the same. You're not a bad person. You're just living your life, doing life as you should. And then things are just more expensive through no fault of yours. And so this is the reality that we need to understand, that there's something called the rate of inflation. And why am I sharing this technical terms? Because it's important we understand when we are talking about the principles of savings and investments. If someone is bringing an opportunity to you, a savings opportunity to you, or an investment opportunity to you, it's important to look at it in the light of how much value you're really getting. So if someone says to you, okay, I'm giving you an investment, and it's at, let's say, for the sake of example, 5% per annum. Right, but inflation is 12%. What does that tell you? That, okay, I'm saving money, I'm getting something back, but it's still not able to meet up. I'm still not able to meet up with my normal expenses, because what used to cost me 100,000 Naira is now costing 112,000 Naira. So what does that tell you? It tells you that, okay, any investment I'm going into, you may not get the 20, 12, 13, 14% investment, but it just tells you that you now need to have a wide portfolio. You need to have a wide portfolio of expense, of opportunities. Okay? You need to have a wide portfolio of opportunities for investment, so that's what is going to actually give you that buffer. The whole point of this conversation is for us to make sure that you're able to have buffers, and so when you need to do anything, you have the capacity to do so. So what I'm showing you, the third column, is just the gap. Again, it's not to scare anyone, because the numbers may be looking pretty huge, but it's just showing the reality on ground. So when we go back to the previous slide, when I talk about the 70, the 20, the 10, why you need to make sure you're managing your expenses as much as possible, because there are things that are happening in the environment that you have no control over. That's the truth. You have no control over. Some people, unfortunately, have lost their jobs. Some people have had their salaries reduced, So, and then inflation isn't waiting. Inflation is not going to say, oh, because you're earning less, therefore things will be less expensive. No, that's just what's going on in the market right now. And so we need to make very educated choices. And it's very important at this point in time that more than ever, we need to be very deliberate about what we're doing with our finances. We need to be very deliberate about what we're spending money on. We need to be very deliberate about the avenues we're sending the money to, not just for expenses, but also for returns. Otherwise, if all you're focusing on is expenses, you'll be living paycheck to paycheck. I've just demonstrated that. And this 12% inflation rate is a current rate of inflation. So this is not futuristic. It's what obtains now. This is what is on ground right now. And that's why if you're buying basic things, it may not show up because you're thinking, okay, 100,000, 112,000, that's a huge jump, but it's something that was costing 500 Naira, it's now costing 550 Naira. It's the little things. It's all in the little things. And so if you're able to manage and get a grip on the little things, then it's easier to get a grip on the bigger things. Okay? So I've spent some time on this. And then, as I said, during the Q&A, I'm happy to go back and share and, clarify any other area. Now, moving on into the next slide. Thou shalt invest, commandment number 2. And I hope you've seen from, the previous slide why it's important you invest, because savings is only going to get you so much. It's also going to keep money aside. But we're saying that if you have a situation where you have a high level of inflation, savings alone won't help you. You need to invest. I need to put money in instruments or in avenues or in areas that are going to bring more returns to you so that you're able to, recoup, and not just recoup, but actually be better off as far as your financial standing goes. So when we're talking about investing, the question is, now look at 2 areas. There's something we call depreciating assets and appreciating assets. Now, what are depreciating assets? These are assets that lose value once they've been purchased. So I'm just showing some very basic things. So ladies, pardon me, but those really nice, expensive bags, once you've bought it, it's depreciated. The nice shoes, the nice lubes, the wonderful hair, but the guys, the cars, when we buy these things, they're nice to have and they are assets, meaning, yes, it's not costing you money. You're not paying, for it consistently, ideally, but it's a depreciating asset. What is a depreciating asset? As it says here, is something that loses value once you've purchased it. How do you know it's lost value? Once you've taken that bag out of the store and you turn around the next day to say, I want to return this bag. Right? Will they take it back? Yeah, the store owner may take it back from you. But if you're trying to sell that bag, they'll tell you it's automatically what they call second hand. Right? So what's the second hand value? So those beautiful shoes that you've bought, if you try and sell it off, it's called second hand. If you're buying the hair, whatever it is, once you look at the second hand value and thinking that second hand value, is it going to be higher or lower? Once you drive that car out, particularly if you're in Lagos, right? You drive that car out and then so Mara, whatever, all sorts of things can happen. Or you go into a pothole and you see the first dent, and for anyone that's ever bought a new car, that first dent is always the most painful one. But once you bought a car and you've driven it off the lot, out of the car park or wherever it is you bought the car from, the value has reduced. If you were to turn around and go back to that same place where you bought the car from 1 month later, they will tell you, okay, I'm going to discount it. Why? Because you have used it, it has depreciated, it has lost value. Now, it's important we understand it so that as we're investing in things, the question you'll be asking yourself is, what is it that I'm investing? And it's important you understand when you're spending money on it, you're saying, oh, I'm buying this thing, it's an asset, it's an asset. Is it really an asset? And what type of asset is it? If you agree that it's an asset, is it the type of asset that's going to give you value back? Should you need to resell it? Because there are times when, you have you have to raise funds and then you need to sell certain things. So, sometimes people talk about things like jewelry and what have you. I did include jewelry here because if you're talking about jewelry is a depreciating asset unless you're buying something that of real value, meaning you're buying a commodity, meaning that the jewelry you're buying is either made of gold or diamond or something, or a real precious metal. Even then, it depends on what the value is in the market at that point in time. So it's important we understand what are depreciating assets and what are assets that appreciate, again. And I'm not saying we shouldn't buy these things. Please don't get me wrong. It's good to have all these things. Really nice. They're nice to have. But just for you to understand that as you're being deliberate and intentional in managing your expenses, we're now the 9th month of the year. So we have 3 months to go, all right? 3 full months to go until the end of 2020. Who knows what 2021 will bring? So whatever mistakes we made at the beginning of the year, now is the time to start putting things in place to correct them. You cannot necessarily correct mistakes of 9 months in 3 months, but you can start putting structures in place so that you're not making the same mistakes over the next year and beyond. So these are what we call the depreciating assets. Now, what are the appreciating assets? These are assets that actually gain value, okay? But they gain value over time. I'll repeat, they gain value over time. Now, if you hear, and people have asked me different questions about different schemes, MMM, MLM, different types of things, or someone will come and tell me, oh, there's someone provided, is giving them an investment opportunity, telling them they're giving them 40% returns and what have you. If something sounds too good to be true, it usually is. especially if that investment opportunity that's being shared with you doesn't have any tangible product or commodity behind it. When people talk about, oh, you put in, and I hear all sorts, people say, you know, if you bring your money, you put in 10,000 naira, then it automatically multiplies. How is it multiplying? What is that? I mean, I don't get it. How is it multiplying? Are you buying something? Are you trading something? And it's possible to get these types of returns. I'm not saying it's impossible. It is possible to get these types of returns if you're involved in particular areas. Perhaps you're doing stock market trading or commodities or currency trading. You know, the things you can take a position, you can make huge, you know, huge margins if you're making the right bets. But that is not, money does not just automatically multiply on its own. You have to put it into a venture, you have to put it into a vehicle. And that vehicle is what is now going to bring that multiplier factor. So a lot of times people say you can't go wrong with land, you can't go wrong with buildings. That's a yes and a no. You can't go wrong in land because land will always appreciate. You can't go wrong with property because property will always appreciate. But there's a caveat: location, location, location. Where are you buying that property? Where are you buying that land? What type of land is it? If you're buying land in a place where, you know, they have land issues, they have Manila issues, you know, the question is, you bought that land, will you be able to sell it? Now, what I've seen in the market in recent times, that a lot of people are trying to sell off a lot of their property just to raise some liquidity. And then the reality of the location that brought their property in is now becoming more real, because you may have invested 10, 20, 30 million or whatever it is, you know, property at that point in time, but now you're trying to sell it. Now realize that, okay, the value of that property hasn't increased. Perhaps in some areas it's actually even reduced because you really didn't look at the environment, you know, and sometimes the environment has degraded as opposed to appreciated. So what am I saying? As far as land and building goes, you need to be very, very clear about the location. This location must make sense. Property in Ikoyi, property in Lekki, property in Ikeja is not the same as property in Ajambadi. Okay, nothing wrong with any place, nothing wrong with either of them, but it just helps you know how to manage your expectations, right? And so you know, if I'm buying this property, right, then this is the type of returns I expect to get from it. So that's on the land and building side. That's an entire conversation on it. So real estate is a separate conversation. But does it mean you shouldn't invest in real estate? No, please invest. I think it's worth investing in real estate, but just know that it's going to gain value over time. Typically, the return value or return expectation for real estate, I mean, the experts tell me is between 15 and 20 years, right, to get your money back, you know, and then you can start talking about getting additional value, unless what you're doing is flipping the property, meaning you're buying it, you add some value to it, and then you sell it. So it all depends on what you want to do. Now, the next one I'm going to talk about is investments. Now, we looked at the interest rates, in the Naira interest rates right now, which are fairly low. You know, for the first time in the market, you know, we have interest rates, well, not the first time in a long time, in the last, I say the last 15, 20 years, we have interest rates that are typically the same as what you get in the US and European markets, which have been single-digit interest rates. Typically, what had happened before that, the Naira interest rates were fairly high, and so you had a lot of external investors coming to invest in Naira, you know, in Naira instruments because of the returns. But now we're seeing that the returns are not so great, and then with devaluation as well. So it's what some people are now doing is investing in FX-based, you know, instruments. Now, those are, so you have two options. Number one is some people just outrightly buying FX and keeping, in the hope that, you know, at some point in time, I'm going to flip that currency. So maybe I'll buy, if I bought Naira at the beginning of the year at 370, I can now choose to sell it. Well, things are dropping a bit now because since the central bank had announced that they're going to start selling to BDCs, Bureau de Changes, you know, that's going to drive down some of the demand, because this FX thing is about demand and supply. The less supply it is, and the higher the demand, the higher the rates, the higher the prices. And we got to a point at some point this year that, you know, dollar was about 500, the pound was about 610, thereabouts. But imagine you have bought dollars at 370 and you're selling at 500. Imagine I bought pounds at 500, you're selling at 610. Are you making a margin? Yes. Is it consistent? Now, unless you have a source of FX that's going to keep bringing that FX into you. Once you sold it, you're back to Naira. Okay, so what some recommendations are that beyond just being an FX speculator, which is what some people do, and that's part of what drives the rate high, because people are speculating, they're buying FX to hold, and then thinking that, okay, if I mop up all the FX, then when the right rate is higher, I'll now sell. which is, I mean, it's not a bad thing, it's business, but you just need to be sure that you have a consistent sort of FX to keep coming back. But you now also have different FX-based investments, and the most popular one that I'm aware of is what they call the Euro fund, Euro bonds rather. And Euro bonds, typically you're getting a rate returns in about 10%, 10 to 12%. But with the Euro bond, you're tying your money down. It's either 3, 5, or 7 years. So it's not something you're going to get back immediately. You'll get your interest rates on a 6-monthly basis, right? But you're tying that money down pretty much for you're investing in 3 to 5 or 7-year bond. And there's usually a high entry rate in terms of the Euro bonds. Typically you need to have about $100,000, $200,000 to come in. But what most investments, what most institutions do is that they give individuals the opportunity to come in at a lower rate, and then that investment vehicle now clubs the money together. So as far as I'm aware, the minimum entry rate for most Euro bonds is about $20,000. But you also have smaller investment clubs and smaller investment groups that bring people together. So if you have a smaller amount that you can club together and then make up that $20,000 or whatever it is to invest in the Euro bond. Now you also see, what I've also seen is that there are different platforms that give people the opportunity to invest in offshore stocks. Okay, so I'm aware of platforms like Chaka and Bamboo, and please hear me, I'm not endorsing anyone. I'm just saying that I'm just trying to make all the options that are available open to everyone. So these are platforms that what you can do is that you take your Naira and then you can use it to invest in, stocks of Apple and Amazon, whatever it is, because they have access to stock exchanges, outside the country. So that's another avenue you may want to look at as far as FX-based investments. Now, here's a caveat. The thing about the money market with stocks go up and stocks go down. So the fact that you're investing doesn't necessarily mean you're going to get your money back. You could lose money. I'll repeat, you can lose money on the stock exchange. That happens. Stocks go up and stocks go down. It depends on what's happening in that particular market, which you have no control over. So the bonds tend to be safer because you know how much you're going to get. But as I said, there's the high entry points that you just need to be aware of. So that's it on FX. And why am I talking about FX? Because the Naira has devalued, it's stabilized somewhat now. But the feelers in the market that there will be further devaluation at some point in time. By how much, I can't say. When it will happen specifically, I can't say. So just need to keep that in mind. And because Nigeria is such an import-dependent economy, what that means, anytime there's devaluation, things automatically become more expensive. So this is part of what is driving that 12% inflation rate that I shared with you at the beginning of this conversation. So it's just for you to be aware of what's going on in the market. So again, as I said, so you're making wise investment decisions. Then the next area I want you to look at, I will suggest you look at, is agriculture. When I say agri, people just think farming, but it's not about becoming a farmer or owning a farm. There's an entire agricultural value chain. Okay, so there's the farm. There's a farming aspect. There are those who are adding value to the produce. There are those who are shipping the produce, those who are packaging the produce, those who are transporting the produce, those who are actually selling the end value product. So there are many steps in the agricultural value chain. There's preservation, because the interesting thing is, as wonderful as the land and the soil we have in Nigeria is, almost the statistics that the Ministry of Agriculture shared is that almost 50%, almost 60% of produce is lost, is wasted. Why? Because they're not adequately preserved. So because you're not adequately preserving agricultural produce, there's a lot of wastage. So if you're able to invest in an area, if you have an idea, if you have a solution, anything that you can do to stop that wastage, automatically you're in good stead. Because what that tells you is that there's an opportunity to create a lot of value. Why? Because if you're looking at people's hierarchy of needs, number one is food. People need to eat. Before people talk about what they're going to wear or where they're going to live, the basic human need is feeding. And food security is a global issue. Right? Nigeria, depending on whichever numbers you believe, you either have 100 million people, 150 million people, 200 million people. I don't know where the statistics are coming from, but either way, there's a lot of people, so there's a lot of mouths to feed. And with what's going on with Corona, with COVID-19, a lot of the things that we're importing, those borders either are not able to, we're not able to import those things as we could do before, or the foreign exchange is not available as it was before, so those imports aren't coming in. So increasingly, we need to look at local production. I'm spending time on agriculture in particular because there's a huge opportunity here. And the central bank has actually put in place a lot of individual intervention funds and financing available for people who want to go into agri. In fact, there are funds that are available for people who are, who are paid employment but want to start small scale agricultural ventures, to show you how much emphasis is being put on, because realize that food security is an issue. If you spend all your money importing items and that money is just not there, that purchasing power is just not there, you still need to feed your people. So increasingly, the government has realized that we need to pay attention to the agricultural value chain. There are other opportunities, yes, and I'm not saying these are the only areas you can look at for investments. That's not what I'm saying. I'm just trying to pick out the topical areas and areas that are already thriving and things that already have a lot of investment opportunities. Now, if you're thinking of investing in agriculture, as I said, the agricultural value chain, you either rolling up your sleeves and getting stuck in directly, or there are other agencies and companies that do certain things. Again, I'm not endorsing anyone. Nobody is giving me, and I'm being careful not to mention names so that I'm not trying to endorse anyone, but I guess people ask, okay, what are the opportunities? So I guess when we get to the Q&A, I can share some of those. If anyone has some questions, some areas where you can actually invest in agricultural opportunities. But I'm just trying to share with you, what's available, so that we don't have to be stuck in this rut of paycheck to paycheck. It's painful to see someone living paycheck to paycheck, particularly as things are getting more difficult. Cost of living is high, is getting higher, and will continue to get higher. So you need to have alternative sources of income. So even if you have your salary, as I said, you're doing your 70-20-10, it's important that you invest in alternative sources of income. So I'll spend some time on here. Now, the next one, borrow. Thou shalt borrow wisely. You may have saved, you've done your 70-20-10, but there are certain times when you just need that little bit extra. For whatever reason, it could be bridge financing, it could be something you need for your business, whatever it is, you should borrow wisely. Now, I'm not saying borrowing is wrong. There's some people that say don't borrow at all. I don't think that's realistic. Sometimes you need to borrow. Now, borrowing doesn't necessarily mean you're going to a financial institution or anything to borrow. You could be borrowing, but you could borrow from friends or family or whatever, for whatever reason. But you must borrow wisely. And what do I mean by that? There are three basic areas you could be looking at. Number one, is it an emergency loan? Is it bridge financing? Meaning I just have a gap, I just have a short gap. I have money that's going to come in. Maybe I'm running a business, the amount I'm meant to get paid, for whatever reason, those who are meant to pay me haven't paid me just yet, but I have expenses that I need to cover. Maybe I need to pay my staff, or maybe my salary was delayed for whatever reason, but I have my expenses, but I know this money is going to come in. So there are emergency loans and there's bridge financing. What are the questions you need to ask? Before you get into any of this, the first question you need to ask is, at what rate? What is that rate? Remember I showed you earlier on that as far as investments and savings goes, the rate is quite low, right? But unfortunately, no, the flip side is that when you're talking about borrowing money, the rate is fairly high. So it all depends at what rate. What rate are you borrowing that money? And then when they give you the rate, and this is very important, you need to ask, this rate that I've been given for borrowing, is it flat or is it per annum? What is the difference? If I say I'm lending you 100,000 naira again at 10% per annum, which means if I lend you that money in January, so that interest rate is going to apply from January to December. So by December, I expect to pay 110,000 naira. That's at 10% per annum. If I'm loaning you that 100,000 naira at 10% flat, that means 10% every single month. So I loaned that money in January, which means I expect you to pay me 10,000 naira in February. I expect you to pay me 10,000 naira in March. I expect you to pay me 10,000 naira, in April, and so on, because that is flat. And I see people make a lot of mistakes here. And like I said, I do quite a bit of financial counseling and some coaching and mentoring, and that's why I want to share this, because I've seen people get into a lot of trouble here because they don't understand the difference between per annum and flat. You may think it's very simple, but at the point in time when someone has a need, they just know here 10% or 5%, not knowing that it's actually a flat rate. So please always ask that question: this money that I'm borrowing from you, is it per annum, is it flat? And then for how long do you want to do it? If you're doing a flat rate should not be done for anything other than a bridge finance. I hear people trying to borrow money over a period and at this flat rate, and they're doing it for 1 year, 6 months. That's a long time, because if you look at it, there's 10% per annum, right? But if you're borrowing at 10% flat, per month, 10% flat is 120% that you're going to be paying at the end of the year. So it's important that you look at the numbers very closely. Now, is bridge financing necessary? Yes, there are times you'll need it. Are there times you need an emergency loan? Yes. But just to be clear how you're going to get out of it, for how long, and then how are you going to repay? Do you have opportunity to repay some of the principal? Because that's what's going to reduce your debt burden. If you find that, I still need this loan, and I need this loan for a particular period of time, ensure from the people, whoever it is you're getting the loan from, that you have the opportunity to actually reduce the principal amount, because the interest you're paying is going to be on that principal amount. I know I'm getting a bit technical, but I've seen people lose a lot of money by just simply not understanding. And I'll give you a practical example. There was someone who borrowed 60,000 naira, right? And was paying, 4,000 naira on a monthly basis. So again, this when you hear 10% to 100, you may not seem like quite a lot until you start putting into actual naira and kobo. And so the person is paying 4%, 4,000 naira every month. But what happened was that the person kept on paying that 4,000 naira every single month, thinking that, okay, by end of month X, I should be done. But what that person was doing was only servicing the interest element. And so when the person thought they were done paying, because in their mind, if I pay 4,000 naira over 15 months, I'll repay that 60,000 naira, correct? No. For the service provider, the person who provided that financing, now 4,000 naira was the interest element. The principal had not been repaid. And so, recovery agents were sent after this guy, to come and take the property and all. And the question is, and as far as he was concerned, it's like, I'm not owing you any money. Yes, you are. What you're servicing was the interest, not the principal. So these are little things that may seem to be little things until one gets involved, now realizes that they're not so little things. So you must dot your I's and cross your T's if you need to take finance and get financing. Another thing is for asset acquisition, because there are times you want to invest in something. I mean, I talked about land, I talked about buildings, I talked about agri, I talked about, so many things that you may want to invest in, and you don't have that liquidity, and you may need to get some support in getting an asset. So you need to be very clear, what is the purpose? That asset that I'm getting this loan for, what is the purpose? What I want to use it for? Is it for investment purposes? Is this whatever is it? And then you also need to ask yourself, will the returns on the asset cover the cost of the loan? Because you must repay that loan. Once you're borrowing money, you must repay. It's important that you repay. Okay. And then working capital loan, and this is usually for business owners where I just have a shortfall. Perhaps I need to pay some salaries, or I have some inventory I need to buy, whatever it is. You must make sure that your business activities will actually cover the cost of whatever it is that you're borrowing. So this section may sound a little bit technical, but I thought it's important to share, because I'm trying to share from personal experiences of what I've seen, what I've heard, situations I've had to get involved in, of people, losing a lot of money and losing property, losing value, losing a lot of sleep, as far as borrowing from different agencies and not really understanding the terms of what they are borrowing or how they're actually going to repay, because one thing is always easy to borrow, but whenever I say easy, it's easier now because now there's so many borrowing sources outside of banks. But if you're going to borrow any money, the first question you ask is, what is your primary source of loan repayment? This amount you want to borrow, where is it going to come from? Where's this money going to come from? Where's my loan repayment? What's my loan repayment source? What's your primary source? And then what's your plan B? If plan A fails, because plan A can fail. As I said, this year has been interesting. People have lost jobs, people have had salaries reduced, the cost of living has gone sky high. So you may have had very good intentions and really plan to repay certain amounts, but sometimes things happen. So what's your plan B if plan A doesn't work? So you must always ask yourself, before you even go and approach anyone, in your mind you must have plan A and also potential plan B. Okay. And then you must always, always have a repayment plan and communicate it clearly to the lender. I cannot overemphasize this. It's important to have a repayment plan and communicate that repayment plan clearly. Communicate it, agree it with whoever it is you're borrowing the money from. Because I've seen situations where people have, just decide to flip the script. You have agreed a particular amount in terms of repayments, and you may now find that it's difficult to meet that up, and you decide you're going to change it. And maybe rather than pay 4,000 naira every month, for this example I gave earlier, rather than pay 4,000 every month, I'm just going to start paying 2,000 every month. But you didn't agree that with the lender. So these are things, they may seem trivial, but these have caused real life issues. People have been locked up because of all these things, because it's a loan default. right? Once you're not meeting up a particular target, once you're not meeting up a repayment, it's called a loan default. And the lender has the right to take whatever action they feel necessary to recover their loan, okay? So it's important. So if you're going to that loan, and when I'm saying lender, it's not always just financial institutions. And sometimes we feel, even if it's a friend or family they are borrowing, in fact, particularly with friends or families, it's important that you have a clear repayment plan that you both agree on, and it is well communicated and documented. So it's not that my guy, you understand now, okay, this is what I need, and we move on. You're my friend, you should understand. You're my sister, you should understand. There's no understanding. Be that person. The person said, yeah, it's okay. No, be that person that says, okay, this is the amount I borrowed from you, and this is how much I'm going to repay you, and this is at what period I'm going to repay you, and here it is, here's a document. If the person says, I don't need a document, at least send an email, send something that documents, because that also shows that you're a person of integrity and character, okay? Now we've talked about you getting money. Now the next one is thou shalt, you must also loan money wisely. Now, can I just ask, just by show of hands, who here has loaned someone money and lost money? Meaning you've loaned someone money and the person has not repaid. Has that ever happened to you? Just raise your hand if it's ever happened to you. Aha. It has happened to everybody. So whether we want to say it or not, you know, people, you know, that they said, it's my goodness. See, when it comes to borrowing money, right, the face that someone shows when they want to borrow money and the face someone shows, right, when it's time to repay, you ask yourself, is this the same human? Is this actually the same person? What is going on? I'll share a personal experience, right? And this happened to me many years ago. It was my baptism of fire, if I can put it that way, in lending. Now, the organization I worked in, this was like 20 years ago, the organization I worked in then, right? There was someone who had an issue. Yes, Oshole can destroy friendships, yes. So as I'm saying that, so I'm not saying you shouldn't learn, but you just need to be very, very clear. So there's this lady who had asked me for a loan, you know, and this was someone that I worked, this was a colleague. This was many years ago. I know this was a colleague, and you know, if I were to describe her, I'd have called her, I mean, pardon me for using the term, almost like holier than thou, assistant Holy Spirit type of person, you know, you just thought this person was just an angel. And then when she came with this need, and she raised the fact that she needed to borrow some money from me, and she asked, and she approached me, I thought, okay, yeah, this person has a need. I know her, or I thought I knew her. I know where she works. At least we work in the same place. So, you know, it shouldn't be so much of an issue. Actually, it shouldn't be a big deal. And what did she need the money? She needed the money. She was traveling, needed the money for a visa because a certain amount needed to be in an account and so on and so forth. Anyway, the long and short of it, I don't have the money. And we agreed that this money will come back at a particular period. Now, because I thought I knew her, I loaned her an amount I could not afford to let go of, because it was meant to be a bridge finance. Remember we talked about bridge finance. It was meant to be a bridge finance, right? Just an amount that she'll need for a short period of time, and therefore the money will come back to me, because I also had things I needed to do with that money. So the time, you know, for repayment came, and next thing, I couldn't believe this was the same, you know, human being. She, you know, when you say she did about 180, I was like, is this the same human being? First of all, she started avoiding me. She started avoiding me in the workplace. Then after a period, I couldn't see her anymore. She wouldn't take my calls, you know, and I'm chasing her. I feel like, why should I be chasing? I personally don't like following up on someone for money, because I thought when you came to me, you didn't have to follow up on me. So why must I follow up on you to get my money back? And you said you needed it for a particular need, a particular area, you know, something that you said was important and urgent. Okay, I also have things I'm willing to do with money. And you know what she said to me? I can't pay you right now, Rola. I said, okay, but I need this money. But you should understand now. I should understand. But that, as far as she was concerned, I don't have it right now, and I give it to you when I give it to you. When I get it, you get it. And that was it. She could not be bothered. Now, someone like me, I may feel like I can't imagine owing someone and, you know, not repaying. But you deal with very different characters in life. You know, you meet with very different people, which is why I said that, you know, it's only God that knows the heart. What you just see is what's outside, what's in front of you. And so what happens is that, you know, this person, she's like, yeah, when I get it, and, you know, and that's it. That she really, truly could not be bothered. There's someone else, I mean, there are too many stories. So I learned very quickly. Number one, if you're going to loan anyone money, do not loan anyone more than you can afford to let go of. Now, this may sound harsh, especially if it's someone that's close to you and the person, needs a lot of money. Now, unless a caveat there is that if you're dealing with someone who's tried and tested, whose character you can attest to. Remember this lady, this was my colleague, but I didn't know her personally. So I realized that working with someone, seeing someone in the office doesn't mean you actually know the person. And then even there's some people that you think you're friends, do you really, really, really know that person? And so, you don't give out more than you can afford to let go, because assume that money doesn't come back. Will it hurt you? If that money does not come back, will it hurt you? If the answer is yes, there's already a question mark. Now, I'm not saying you shouldn't loan the person any money at all, but then you need to look at how much, so that if it doesn't come back, you're not going to have relationship issues. You're not going to be calling family meeting. You're not going to be calling people supervisors. Oh my goodness, I can't tell you how many people are financially irresponsible and badly behaved. And even I, as a supervisor, over the years, I've had people call me. How they got my number, I don't know. I've had people call me about different people I've supervised at different points in time, to say that this person is not repaying the loan. I'm thinking, well, so what do you want me to do about it? When you guys had the agreement, I wasn't involved. This is not an official issue, but the person is paying, so they're just asking themselves what they can do. So you need to loan money wisely. Understand that people are very different. Understand that people's principles are very different. Understand that people don't necessarily have integrity. And at any point in time, if you're loaning any money, don't loan more than you can afford to let go of. If the money doesn't come back, it's okay. So that you know what, the money is not coming back, it's okay, it's okay, it's okay. It's not an amount that's going to cripple you. So that's it on loaning money, okay? So you should borrow wisely, but also loan wisely. Again, as I said, there must be a clear repayment plan. And number 5, very, very important, and this is where we start running up. Thou shalt not act as a guarantor for a loan you cannot afford to repay. Again, I'm sharing this because these are things that I've seen that have caused issues. People have lost their jobs because of this. These are real life issues where I've seen people act as guarantors. And I'll give, again, every example I'm giving is a live, real example. I'm just not going to name any names. There's someone, again, a work colleague, and I guess some people have been burnt from this as well. There's work, yes. There's someone, yes, Esther, number 5 is for real. And I'll give 3 examples, and these are live examples. I said, I'm not going to name any names, but there's someone who had acted as a guarantor for a loan for a family member. And at the point in time when the family member needed the loan, because what happened was that this person was in paid employment and the family member, was a business person, and therefore it was easier for the person in paid employment to get the loan and to act as a guarantor for that loan, right? And then everything was going well until it wasn't. So what now happens? Remember, the loan providers will always go to the primary source first. If the primary source fails, they will face the guarantor. And that is what happened to this person. Now, this person acted as a guarantor for the loan, had written a post-dated check, and so the check was just thrown in. And this person did not have the money, did not have the money at that point in time. And unfortunately for that person, the person worked in an area where if you get a check, a returns check, right? It was a problem in that area because the person worked in a financial institution. So it would be a problem, right? And so the first check was returned. The second check was returned. Guess what? This person had to go on suspension. So these are real life issues. There's another issue where someone acted as guarantor for someone. At the point in time, they were both colleagues, and everything was fine. And the person moved on to a better job, a better paying job. So imagine you are maybe a manager in company X, FMCG X, and then moving on to be a senior manager in another company. So, but the person that acted as a guarantor for you is actually on a lower level, but thinking, well, you're even doing better than me anyway, so it shouldn't be a problem. Guess what? The senior manager in FMCG X lost the job because life happens, this thing happens. So unfortunately, that person now could not repay. So the debt burden for that other person's loan now fell on this person who was earning less than the person who acted as guarantor for. Again, these are real, I'm just not naming names, these are real life examples. So this person, because this person was a person of integrity, had to pay, actually took on that debt and was a very, very painful process. Now she had to start repaying the loan for someone else, a loan that you didn't take, a loan for someone who was earning more than you. So you thought it wouldn't be a problem. So when I say that, don't act as a guarantor for a loan you cannot afford to repay, because you don't know tomorrow. You don't know what life is going to bring. Everything may seem fine. I give you 2 examples. I have so many more, but in the interest of time, because we need to start rounding up, there's so many more that I could share. But the reality is that we don't know what tomorrow will bring. We don't know life, and you really, really don't know a person. Remember the situation like this last example that I gave, the senior manager versus the manager in the FMCG. I mean, the senior manager could have said, you know what, I mean, let me even try, let me even, support you. But that person was like, you know what, I've lost my job, I don't have an income, so sorry, sorry, that's it. For the family member did try, but the family member had had health issues, so could not repay. So there are times when things just happen, life happens. And so I'll repeat this and I'll end with this note. Do not act as a guarantor for a loan you cannot afford to repay. We've talked about expenses, we've talked about savings, we've talked about investments. Would it be so painful that just because you wanted to help someone, you now lose not just your income that you've set aside for expenses, but also the buffers you put in place just because something happened to someone else? So it's important, don't act as a guarantor for a loan you cannot afford to repay. Don't loan money to someone you can't afford to let go of. Don't borrow if you don't have a reasonable repayment source. These are things that seem very, very basic. Yes, Rakemi, it's so true. You need to be mindful because people have been burned. I'm just not naming names, and I don't intend to name names, but if we're to go into how many people have been burnt, we will be here for a while. So as far as managing money goes, there's the managing money for yourself, because the only person you know is you. That's the truth. The only person you know is you, and even you will face circumstances. This year, everybody has faced a shaking of some form. So if you can be shaken, imagine what's happening to somebody else. So as you're going through this, like I said, we're having just the 5 money commandments. Number 1, thou shalt save, because the shocks will come. Number 2, thou shalt invest, because saving is not enough. Yes, if you're going to borrow wisely. If you're going to lend money, lend wisely. And please, 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 because these are very tough times. And you'll see that a lot more people are asking for loans, either come to meet you directly, because things are tough, for a number of people. And that additional buffer is required. So you must make sure that you're not setting yourself up, to take on someone else's burden. And finally, this is not a money commandment, but this is more of a life thing. Be a person of integrity. Be a person of integrity. Because what I've seen over time is that when you act with integrity, it opens so many doors for you. It helps you. Remember I gave the example of someone, the lady who burned me, took the money and said, well, I see you. She never paid, by the way. She never paid. And she was perfectly happy to see me in the office every day and walk past me. Perfectly happy. No qualms about that. You have people who borrow money from you, and next thing you see them bawling and living life, and you're thinking, on my money that I'm suffering from. So even if people around you don't have integrity, you decide that you will be a person of integrity, because the asset that integrity gives you cannot be quantified. Once someone knows that, okay, I'm looking at, I'm dealing with these people, and I know that Anna's a person of integrity, Esther's a person of integrity, Kemi, Esther, everyone, Ellen, Aloye, you're people of integrity. That is value on its own, because I know that I can trust you, and if I know I can trust you, then I'm willing to extend myself for you. And that goes I'm not talking about me now, I'm saying for anybody. So you're willing to extend yourself for a person who demonstrates integrity of character. So bottom line is that it's important that we also ensure that we are people of integrity, because that will take us further than any naira and kobo, dollars and cents ever could. So with that, I will pause here and open the floor to see if anyone has any questions. So are there any questions? You can raise your hand if you have a question, so I can unmute you, and then we can take whatever question. Is there anything you want me to cover again? Anything you'd like for us to recap or clarify? So questions. Okay, Esther. You can unmute yourself, Esther.
Okay. Is afternoon. Good afternoon, everybody. Thank you so much for the insights. I mean, definitely very also useful. My question is particularly on saving for children. I mean, I heard you say 70% of expenses, so 70% should go for expenses. But maybe being a mom of, and I just have one for now, right? A toddler of 4 years old, and I already see school fees increasing in the next couple of years. So my question really is, how do we, is there a special way to save for children's income? I mean, years ahead and all. So that's really my question. Thank you.
All right, thanks, Esther. So I'll try and give a practical example. You know, one of the things I shared, you know, was about that 20% going into a different account. What you can do, I'll tell you a practical example. One of the things that I did with my son was when he was born, I opened an account, what we call the savings account, okay, for a child. And I just set that amount, that's account aside. I put it was very separate from my salary account. In fact, it was in even a different bank because I didn't want to be tempted, you know. And so on a monthly basis, there was a certain amount that I was sending to that account every month, you know. So if you can, so that's one. You can actually open a separate account for the child for the purpose of saving for school fees, which will always every parent, you will pay school fees, and the school fees are not they're not laughing, as I say. You always have to pay. There's money that needs to be paid. So you have an amount that's going every month, you know, for school fees or whatever it is that you want to create for. It could just be, you know, a future plan for the child. That's one. Then two, there are actually other areas you can invest in. So there are things like mutual funds that you can actually do in your child's name. Okay, so you may not be able to invest in the stock market or things like that in your child's name, but you can actually set up mutual funds, and there are quite a few that exist. You know that you can use that to start setting aside funds for these school fees that we all must pay at some point in time. So those are the two areas I would recommend. Open a child savings account, meaning you don't need to call it child savings account, but a dedicated account for the child. If you can have it in the child's name, fine, and just set it aside and then X amount and be disciplined about it, which is why I give the example of the standing order, because if it's automated, it's easier to be disciplined. Because if you just look at how much this you have available, it may be difficult to keep that consistency. So do that, and then also the mutual fund. So at least that gives you the opportunity to actually go, rather than just setting the money aside, you can actually get more interest. So I hope that answers your question. Fantastic. So is there any other question, any other area anyone would like me to address? Okay, Shirley, you can unmute yourself.
Good afternoon, Aunt Rolaya. Good afternoon, everybody.
Hi.
And thank you so much for this very enlightening session. Earlier on, you mentioned the agricultural value chain, and you also mentioned investment opportunities that you would share later. I wanted you to touch on those two things.
So on the agricultural value chain, there are different vehicles that are in place now. Again, I am not endorsing anyone, okay? But there are two, I mean, you hear things about, you hear PiggyVest, you hear Farm Crowdy, you have Thrive Invest, and what these guys do, particularly Farm Crowdy and Thrive Invest. Again, do your research. In anything you're doing, please do your research. But one thing I know that they do is that they actually invest, but they focus on the agricultural value chain. So some of them provide funding for farms, farm produce or farm packaging and what have you, right? And you just put in a certain amount, you know, so you're not having to invest millions and millions, because agriculture can be expensive, especially if you're trying to do it by yourself. So those are avenues that you can use to sort of like test the market. And then the question also is, are you also part of any like maybe SME type association that's doing anything in the SME, in the agri space? Because it's also useful to look at that to see what are the investment opportunities in those areas. But if it's something you want to just do to start testing the space, then you can try with those types of vehicles and see, okay, are those returns worth it? Because it's fairly safe, if I can use that, safe in the sense that you are sending the money on an errand, if I can put it that way. You're not actually the one going to the farms and what have you. So and the average interest rate that I've seen ranges from about 12 to 20%, which is fairly reasonable looking at the agri space. So 20% returns, 15% returns in agri is fairly reasonable, because as I said, there's a lot of wastage. So it's a reasonable. So you can try those areas, test it, But if before you invest in anything, if you're investing in any of those areas, make sure that at a minimum, your principal is guaranteed. Now, people will not be able to guarantee you the interest because things may happen, but make sure that your principal is insured rather. So your principal is insured, so at least you don't lose your initial investment amount. You may not make back, you may not make that 15, 20%, but at least you won't lose what you put in. So it's important that your principal, ensure that whatever vehicle it is you're putting the money in, your principal is insured. Okay. So that answers that question. Okay. So someone is asking in the chat group, Oluwakim is asking you're asking me what I think about black tax and how we can avert it. Please clarify, is it back taxes or black tax? Please clarify so I know how to respond to that question. That's from Oluwakemi. But otherwise, if anyone else has any question, you can just raise your hand so we can unmute you. Okay. Money to give to relatives and family members. Okay. How do you want to avoid giving money to relatives and family members? See, the truth is, there's some things you just need to do in life, right? And you just know that that is under CSR. Let's put it that way, okay? There's CSR. You can't go through life without, the interesting thing, the way we work in Nigeria, right, is, particularly Nigeria, because the majority of us are here in Nigeria, is that, we don't have a governmental welfare system. So the family is the welfare system. And so because the family is the welfare system, there will always be someone, some relation, either near or far, that you are supporting in some way, shape, or form. And the question is, how do you do that consistently, sustainably? I shared this with someone the other day. Again, I try to be very, very practical. I'm not going to name any names. I'll give you every example I'm giving is a live example. Now, this person was struggling. Why? Because this person was supporting, and when I say supporting, literally carrying family members. So Auntie X, she sends X, again, I mentioned a lot of ladies, so most of my examples are from ladies. Auntie X, she sends X amount on a monthly basis. Uncle Y, she sends X amount on a monthly basis. Cousin X, she sends X amount on a monthly basis. And then she's looking at her salary and she's saying, I can't cope. I have things I need to do for myself. But because she started doing this, she felt burdened, that it's a burden I must carry, because they're looking at her and say, okay, you are the savior. You're the one that's going to sort these things out for us. And I'm going to say something that may sound tough, but it's something we must be very mindful of. A drowning man cannot save himself and everybody else at the same time. You need to decide who you want to save. You need to decide who you want to save, because if you're drowning, you'll be useless to yourself and everybody else. What is it that you can do sustainably and consistently? And remember, I said, if you're going to give someone, don't give more than you can afford to let go. So perhaps, again, since we'll be using the example of 100,000, assuming your salary is 100,000, right? Now you can decide to put those family members as part of that 70%, expense list, if you can afford it. If you can't afford it, then you need to be very real that perhaps rather than sending 10,000 naira, every month to cousin X or Auntie Y, you can only afford 5,000. Now would they shout, yes, what's wrong with you? Before you used to give me 10,000, now you give me 5,000. Is it because of this? Is it because of that? You're now too big. No, whatever it is you can do sustainably and consistently, because if you can't feed yourself, you can't feed someone else. If you cannot save yourself, you can't save someone else. A drowning man cannot save himself and other people at the same time. You need to be afloat to do that. Now, this may sound very, very harsh, but it has to be said, and you have to be realistic and consistent in whatever it is you want to do. I'll give you a practical example of someone that I know went through this. Again, this person was supporting family members, helping them through medical issues, took a loan, so to help family members sort out medical issues. Guess what? Family members are now fine. Everyone's doing okay. And they've left this person with a burden. That's life. And then the question is, they'll say, well, we didn't ask you to. I didn't ask you to take a loan on my behalf. I didn't ask you. If you're going to afford it, why did you do it? So people will always be people, but that is not to say you shouldn't do your part. Remember, in Africa, specifically, the family is the welfare system. So there will be welfare. You know, there will be welfare that you need to share, and that's the truth. Exactly, Shola. You need to be more logical than sentimental. See, in Nigeria in particular, which is very interesting. Maybe it's because I worked in different parts of the world, and I see in Nigeria in particular, we're very sentimental. Very sentimental. You know, we use emotion a lot, which is why I was saying that if you're going to lend money, lend it wisely. You know, I asked someone the other day, you know, because this person was having an issue. I was asked to intervene in a particular issue between someone who had borrowed money and someone who was failing to repay. And I asked the person, what is your repayment plan? Guess what the person's response was? I will beg. I will beg. So begging is your repayment plan, meaning you have no intention of repaying that loan, but your answer is to beg. And that's how majority of us in Nigeria are, unfortunately. We want to beg our way through, use emotions our way through. So you need to be very logical. Yoshila, you're right. We need to be logical and sentimental. Do we have a responsibility to family? Yes, we do. Yes, yes. But remember, as I said, there's a social welfare aspect. So we are, you know, the social welfare, but the family welfare. But a drowning man cannot save himself and save others. You need to decide. You need to be afloat to keep others afloat. Okay. Yes. So Esther said she sets a percentage of her income for giving, and when it finishes to the next month. Let me share what someone shared with me, which has helped. You know, she said, look, this is what he does. That on a monthly basis, income comes in, and then he has a pool. This pool is X amount is going to tithing, offerings, and what have you. This pool is going to family expenses and, you know, what have you. Then this pool is for, you know, CSR. Once that pool finishes, that's it. So again, because we're using the 100,000 naira example, assuming my CSR pool is 10,000 naira. Once that 10,000 naira pool has finished, that's it. We're done until the next month. And so when someone is asking you a question, you can say, honestly, sorry, I don't have. Because if you've given more than you can spend on your actual expenses and your needs, then you'll be shortchanging yourself and shortchanging those who are depending on you. Okay, so you cannot be Father Christmas or Mother Christmas or Santa Claus or Mother Claus or whatever it is. You know, it's important we do that, because remember, you owe a responsibility to yourself to ensure that you stay afloat, because it's when you're afloat that you can help others. You can help bring others up. But if you're drowning, you can't save yourself just because you save anybody else. And the better you're doing, and the better you help others do. So as I said, I'm not saying don't help others. No, no. I believe very strongly in welfare, in giving, in helping others, you know, in any way, shape, or form you can. But you must do it with logic and with understanding and with maturity, so you can do it consistently. Okay? No is not necessarily bad. You see, the best word you learn in life is no. You know, for those who've ever, you know, been around children, especially those twos, what they call the terrible twos, right? The word the child says the most is no. We will do well to learn that, because we tend to say yes to everything. Auntie, can you give me? Yes. Oh, uncle, can you do this for me? Yes. Oh, because you don't want to seem like a bad person. But sometimes you need to say no. You need to say no for your own sanity, and so that you can be useful to others. So you can be useful to yourself and useful to others. Okay, so don't try and be all things to all people. It's not sustainable. You can't do it. You will burn out. You will burn out. You'll burn out mentally, physically, emotionally, financially, everything else. You will burn out. So it's important to say no. Again, not just say no randomly, but to understand that you're being strategic, you're being intentional with your finances. You're being strategic and intentional, because this is one area, why I wanted to talk about this, because this is one area that's very, very thorny for a lot of people. A lot of people struggle with. So you need to be very strategic and intentional. And we're in very interesting times, and these times will only get a little more interesting. I was in a session the other day, and people were talking about, you know, the old normal. I said, the old normal has gone. It's gone. It's packed his bags, locked the door, bolted, thrown away the key. Old normal has gone. This is the current reality. And so in this current reality, how do you ensure you're not just surviving, you're not existing, you are thriving, and you're doing very, very well? Because when you're doing well, you can help others do well as well. So you're not going to be selfish, but you're functioning with wisdom and understanding. And exactly, Kemi, you need to learn to say no. You need to learn to say no. You can't be all things to all people. You can't. It's impossible. Okay, so I promise that this session will be 11 to 12, a little bit over time. Apologies for that. But if anyone has any question, I'm happy to share. I'm happy to answer any additional questions. If you can just raise your hand or put it in the chat group. I hope I haven't missed out any questions. If I haven't missed out any questions, I think yes. I think I've covered all the questions. All right, so thank you. Thank you. Like I said, this was something I wanted to do for those who have been, part of the newsletters and be signing up. What we'll do is that I'll make this recording available, so at least I will share it on newsletter as well, so you can take some time, go through it, go through the things we've shared. If you want to share with others, do that as well, so that others can learn. I find that people really need to learn. Money is not something people really talk about. People tend to think money is bad, and and there's a very wrong adage where people say, money is the root of all evil, which is not true. The Bible actually says it's the love of money that is the root of all evil. Money is something that you need to, that is a tool, the useful tool. But this hour would have been a waste if all you did was listen and you're not going to implement. So implementation is the key. So what I'm looking to you to do is to be the implementation ambassadors and start implementing, Yes, I know you'll share the recording. No problem, we'll share the recording. So you need to be the implementation ambassadors, because when you start living it out and you start seeing the difference in your life, then it's going to help others as well. You're meant to be the bright light. You're meant to be a light that is shining. You're the city on the hill. So you're going to shine this light and show people how to work, how to deal with money. You're not a slave to money. Money is a tool, and it's a faithful servant. Remember, we said the money will go anywhere you send it. If the money is the hand of a fool or a wise man, the money will not jump out of the hand of a fool and say, you're a fool, I can't work with you. No, the money, it's a servant. It will go wherever you send it. You send it on a useless errand, it will go. If you send it on a useful errand, it will go. So money is just a tool for us to use, and to use wisely. It's not something that should be a source of distress to us. And helping others should not be a source of distress to us. Needing help shouldn't be a source of distress to us, because we all need help at different points in time. So I'd like to thank you for joining this session. It's been a pleasure. And as I said, this recording will be shared with everyone. We'll send the link out. And that's it. So thank you. Enjoy the rest of the day.
Thank you so much. Thank you.
All right. Have an awesome day, everyone.
You too.
Okay. Bye.